ASML reported earnings yesterday and the stock dropped 5%, taking the company's market value to €225 billion. With 9.1 billion of cash on its balance sheet and 3.7 billion of debt, the company's total enterprise value is 220 billion. Revenue over the past 12 months comes to 31 billion, with 8.7 billion of net income and 9.3 billion of free cash flow. So ASML stock is valued at 26 times earnings and 24 times free cash flow, and the company also pays a dividend of almost 1%. ASML builds complex lithography machines that are used to make the world's most important microchips. The company has a monopoly in the industry, and this was another solid report. Revenue of 7.7 billion euros was 45% higher than last year, and gross margin of 54% was above expectations. Net bookings were soft, but ASML's high-priced machines often lead to lumpy orders. The most important thing is that management reinforced its guidance for strong growth this year and next, while maintaining its long-term targets. Specifically, ASML expects revenue between 30 and 35 billion this year, with a target of 44 to 60 billion by 2030. Crucially, the company expects long-term gross margins of 56 to 60%, which would represent a significant improvement to the bottom line. Of course, this growth is being driven by the boom in artificial intelligence. According to reports, Nvidia will soon overtake Apple as TSMC's largest customer for chips. But despite ASML's good results, the stock continues to feel the pressure, and it's not hard to see why. President Donald Trump's recent tariff policies are disrupting global trade zones and causing huge amounts of uncertainty. While ASML's products are unlikely to be exposed to the highest tariffs, there is huge uncertainty around what tariffs it will need to pay and how it will impact customers like TSMC, Samsung and Intel. On the company conference call, ASML management repeatedly spoke about the uncertainty and disruption that's being caused. And the risk to ASML is complicated by the fact that the company still derives almost a quarter of its sales from China. The concern is that ASML will need to choose between the two countries, or that orders will be delayed. On the other hand, a global trade war could see more splintering of factories, which could in theory lead to more orders. The uncertainty facing ASML is hard to quantify, but what's not up for debate is that the world wants its machines. One way or another, ASML will continue to do business and continue to grow. If you assume that ASML manages to hit its targets, the company could be reporting 50 billion euros of revenue by 2030, with a 34% net income margin. That would put net income at 17 billion in 6 years' time, and a 25 times multiple takes the valuation to 425 billion. Account for cash and share-based compensation, and the annualized return works out to 11.3% a year. That seems reasonable, since ASML is a desirable business that usually trades at a higher multiple. But these are my personal opinions, not financial advice, and I hold no position in ASML stock. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.